Hey you guys, my name is Mehak Begaman, and on this video, I'm going to cover concepts like bonus depreciation, recapture on the sale of the asset. So if that's a question that you're working through right now and are unsure what your exposure is, if you're selling an asset that has gone up in value and that you may have taken bonus depreciation on, or you have an asset that you're not sure if you should take bonus depreciation on through a cost segregation study, this will be super relevant to you. So if you're a real estate investor and using cost seg as a tax planning tool, of bonus depreciation. This is a concept you absolutely need to understand before you either conduct the study on your property or sell a property that has been heavily depreciated. This concept of depreciation recapture. So accelerated depreciation can save you tens of thousands of dollars front, but if you sell too soon, a large portion of that benefit can quickly unwind. In this video today, I'm going to explain depreciation recapture in simple English. I'm going to walk you through two real estate investor scenarios, and I'm going to show you how holding period is often the difference between a smart tax strategy and one that unwinds pretty quickly and does not result in actual tax saved. So let's start with the basics first. Depreciation allows you to deduct a portion of your property's cost basis, reducing your taxable income, right? So let's take an example. Let's say you have a single unit, single family home that is a short-term rental. In this case, it ties directly into my examples. So if you have a long-term rental, you can replace that terminology. But let's say in this case, it's a short-term rental. It's one dwelling unit. And essentially, we can take that asset. Let's say the purchase price on this asset was $450,000. And we can take this asset and depreciate it. So under normal depreciation rules, you would take the entirety of that cost basis of $450,000. First, we would allocate the land basis. And that's often available on the record. We always have to take a close look at that, make sure we're aligned with how much of that value is land basis. We often find that, beach properties have more of the cost allocated to land value versus a building basis. This is extremely important, right? Because land we know is not depreciable. Therefore, the amount of cost we can allocate to the building directly impacts, your positive or lack thereof outcome in the cost segregation study. So that's step one. The next step, and I'm giving you the mechanic around how this study works and how you should think about it. The next step is let's say of the 450,000 in our example, 400,000 was building basis. A cost segregation firm will come in then and take the building basis of 400,000 and start to split it up into three component parts. Okay, they're going to split up into 5-year assets, 15-year asset, and in this case, 39-year assets. Now you might be wondering, how do they come up with this arbitrary allocations and what are these asset lives? So the 5, 15, and 39-year asset class lives, they line up with the IRS tax tables. The cost segregation firm will come in and they're asking you for specifically, of course, the land basis, the county record on the assessment, closing disclosure, and then any rehab or furnishings that you might have done with your rental so that they can start to piece together the improvements that you've made since ownership changed hands. Then they start looking at what would be bucketed as 5-year asset class. So some examples would be carpet, appliances, lighting, window coverings, movable objects, right? So that's what I'm thinking. 15-year asset class oftentimes is going to be land improvements, which are pretty common with our short-term rental business owners because they are adding more of the wow factor to their assets. And so therefore, there might be some more land improvements with short-term rentals in comparison to long-term rentals. But nonetheless, we still see 15-year asset class, fire pits, an outdoor shower, or even sometimes a hot tub, depending on what the improvements are. Pools are a little bit tricky depending on the type of pool. It may or may not qualify for a 15-year asset life. But nonetheless, you take your $400,000 basis overall and split that up. And the reason we're going to split it up is because now we're going to apply bonus depreciation rules, which were reinstated under the one big beautiful bill. Your 5 and 15-year asset class, we can take the entirety of that allocation. So let's say $100,000 of the $400,000 total basis got allocated to 5 and 15-year asset class. So now in this year, let's say tax year 2025, we can take the entirety of the $100,000 against your earned income. I'm not going to go into rep and how passive and non-passive loss is. Passive actually loss rules apply. If you have questions around that, reach out to me. But for this discussion, we're assuming that we can group these losses together because in our example, both our taxpayers meet reps or qualify to take the losses. Just high level on this is that you're taking the overall basis, splitting it up, pushing more of it into the 5 and 15-year asset class, and then being able to take 100% of that in the first year. So that's the benefit. Well, now where does recapture come into play? So in my example, I said at the top of this video that holding period matters a whole lot, which it really does. So let's say in my example here, Sarah owns this asset and took the benefit. She took $100,000 upfront, which saved her $20,000 in taxes, and it was a favorable tax year. She's happy. We're happy. The strategy worked the way it was intended. Now let's fast forward to 2026 tax year. The market has shifted. Occupancy has dropped. Cash flow has tightened. Sarah's feeling very stressed. She is forced to sell, and she does get an offer that she likes, so she is ready to sell. And she's got a couple of problems. She's got capital gains on this asset. Presumably her, even though let's say the market hasn't moved all that much, she paid $450 for it, and she can either break even or sell it at $450, $475, somewhere in that neighborhood. In her mind, she's thinking, well, I don't have any capital gains because I'm selling right at cost, quote unquote. But that's not the case, right? Because she took depreciation on this asset. So her basis, her tax basis, is her whatever she paid for it, $450, minus all the depreciation that she took, which is quite a bit, right? 100,000, we said. The difference between her new sales price and her basis is substantial. That gain gets split two ways: capital gains and recapture. So I want to simplify this even furthermore. Say, when we're thinking about recapture, the 100,000 in my example that she took as bonus depreciation, it reduced her overall income, right? So let's say her earned income was 250,000. She took 100K losses. It bumped her into a much lower tax bracket at 150K. When she sells the asset, the recapture maintains what I think character of that income, i.e., she ends up having to recognize as phantom income, even though she only made 250 in the following year as well. I say only. Her earned income is still 250,000, but the $100,000 of the reduction in her overall income that she experienced, now she has to pick up $100,000 of ordinary income, although she didn't make it another 100,000 on the sale of the asset, right? So you kind of start to piece this together where you have cap gains, which is generally favorable, 15% tax rate on long-term capital gains. Recapture tends to be pretty unfavorable, especially if there's a substantial amount of cost segregation benefit that was received in the previous year. I say all this to set up the framework that we don't want to just do a cost seg because it makes sense from, some of the short form content that pops up with tax strategies. We really want to think about this as a multi-year strategy, and holding period is a key component part that you have to consider before you engage in the study. So when we're doing this with our clients, I'm walking our clients through this decision tree to say, is there enough basis? Does the cost segregation study actually make a difference? In Sarah's case, it did. Then are you planning on holding this asset? Are you feeling really stressed about cash? Do you think that if the market turns, will you be very, very quick to take this asset to market and sell it to indemnify yourself of the cash because you're just feeling a lot of stress around cash? And then the third one, which is a little bit subtle, is to say, what else is happening? What else is coming down the pipe next year? Is your income going up? Are you selling any other appreciated assets? I have a client right now who's selling her business. It's going to be a multi-seven-figure gain for her. So what else is going on? We have another client that we were planning on doing cost segregation studies on 3 assets in 2025 tax year, and then looking at the projected income for their business. We actually are going to push those studies into 2026 because their income is going to double in 2026. You start to kind of see my thought process behind this, which is we want to be aligned with overall business direction that you're going, and we wanted to have the most benefit overall, not just a slight benefit in the first year. So I hope this was helpful. If you have questions around either you have an asset that you feel you could benefit, you have high income, you have a new asset, you don't know if you should do a cost segregation study on it, reach out to me. We can walk through actual models. We do the calculations for you so you can see the benefit received and make a decision based on numbers, not just the idea of doing it. Number 2, if you're an investor who is liquidating rentals for one reason or the other, you're repositioning capital, you're concerned about capital gains and recapture, reach out to me. A lot of clients that I see come to us generally say, I wish I would have known. I wish I would have been able to see the numbers. I would have positioned my capital or maybe would have done a seller carry or would have done a 1031, so on and so forth. So I think the clarity is really the piece that we're solving for. If you have the clarity, then you can make a better decision around the best way to exit a deal and or reposition your capital. So it's all things.